Alright, this is your problem. This is P1729A. And what I thought I would do is kind of go through and just explain where the numbers come from. So this is what we see here is a job cost record. It has direct materials, it has direct labor, and it has manufacturing overhead. And those three things, DM, DL, and overhead, are how we arrive at the total job cost. So there's some information given to us in this problem. Let's go ahead and open up one of these tables. In this case, we don't really need very much of this information, but it does tell us kind of the details. So this material requisition, this tells us when we brought some information, requisition some materials, and you can see those are the same amounts that are there. And then when employees worked on the job, and you can see those are the same amounts there. So you correctly totaled these. This is the total of the DM. Here's the total of the DL. And then we have our overhead allocation. Now we don't record actual overhead to our jobs, but we use a predetermined overhead rate. And so the predetermined overhead rate, and you may have calculated these things backwards, because I think your answer was 80%, which I think is just backwards. So in this case, it tells us that the estimated overhead for the year is $540,000, and our estimated direct labor costs are $432,000. So we divide that 540 divided by 432, and that's how we come up with 125% of the direct labor costs. This job was completed on April 3rd, and so that's why April 3rd is the date that we're going to allocate the overhead. So April 3rd, 125% of direct labor costs. So in this problem, the direct labor costs you totaled at 400. So 125%, or 1.25% of 400, is 500. And that's how we get the overhead of 500. So our materials are the 1142, the 400 for labor, and the 500 for overhead gives us a total of 2,042. It asks what's the cost per DVD. This job was right here, 5,900 DVDs. So we take the 2042 divided by the 5,900, and that's where we round to like 35 cents. Okay, so that's completing the job record. We can close that. Now it asks us to journalize several of these transactions. And the way I like to think about this is looking back at the T accounts. So we have basically 5 manufacturing T accounts: raw material, work in process, that says WIP, and finished goods inventory. Those are all inventory accounts, so they're balance sheet accounts. Wages and overhead are expense accounts, but they need to be zeroed at the end of the month. So let's go back and look at this. So this says let's journalize the direct materials. Well, we know the direct materials were 1,142, and that comes from here to here. So we're going to credit the raw material account and debit WIP for the direct materials. Maybe I don't want that arrow on there. Alright. And that's what we ended up doing here, crediting, going out of raw materials into work in process. Wages, it says, let's journalize the direct labor. Same thing, right? So our wages, we've incurred a bunch of expense on the expenses on the debit side. Now we're going to move it to WIP. So we credit wages, and that's a DL, and we debit WIP. So we're moving everything to our work in process account. And that's what we've done here. Finally, our $500 of overhead. Again, our actual overhead is on the debit side, but what we allocate is on the credit side. So we credit here and debit here. And that's what we've done there. And then the last part was just basically it's just recording the sales. So once we've completed this, so this all totals what, 2042. Well, once this job is done, we're going to move it out of WIP, and we call that the cost of goods manufactured. Cost of goods manufactured, and we move that to finished goods inventory. And then of course once we sell it, and this goes back to like financial accounting, once we sell it, we're going to credit inventory and debit cost of goods sold for the cost of it, which was the 2042. And whoa, that's moving all around. You can see that here, right? So we move it out of WIP into finished goods inventory. Then we record the sale. So we record the price, accounts receivable and sales revenue for the amount of the sale, and it probably tells us what we sold the DVD for somewhere up in here. Yeah, we're going to sell it for $1.30 DVD, and we had 5,900 of them, so we multiply those two and get $76.70. And then the cost of the DVDs are the 2042.